economist Mohamed El-Erian issuing a bleak warning about what's ahead for the economy, placing the blame squarely on the Fed. Listen to this.
There is a possibility that the Federal Reserve makes another mistake and that bumpy journey actually changes the destination. That is the cost of a Federal Reserve being late. Not only does it have to overcome inflation, but it has to restore its credibility. So yes, I fear that we risk a very high probability of a damaging recession that was totally avoidable.
Forbes Media CEO Steve Forbes joins me now. Steve, always great to see you. I want to get your reaction to that because the Fed did say that inflation was transitory for quite some time. What Mohamed El-Erian is suggesting is, had they taken it more seriously, had they start to incrementally raise rates before they did actually start in earnest, we wouldn't necessarily be in the situation we're in now.
That's right. And both the Federal Reserve and the administration seem to be in coordination of doing everything they can to hurt the economy, slow it down. Unfortunately, the Federal Reserve believes that the way you fight inflation is by depressing the economy, slowing down economic activity, making people poorer. And so that's what the point of all of these raising of interest rates is, to hurt the economy. And if the Fed doesn't understand, the way you fight inflation is by stabilizing the value of your currency, the dollar, which is in the last couple of years gone up and down like a yo-yo.
Yeah,
so the Fed is giving us unnecessary pain.
It's skyrocketed as of late, the U.S. dollar index. And we're looking at the market, Steve, down. The Dow's down 52 points as we speak. The Nasdaq's taking a hit of 105. We had a very volatile week last week as well. Got the jobs number. Actually, the market was looking for a worse number. That might be a sign that the Fed could ease up a little bit. But we're not getting any indication that that's going to happen.
Well, that's the thing. It's kind of perverse. We got a couple of great rallies, as you know, not so long ago, on the theory that the economy was doing poorly, so therefore the Fed would stop bashing it. And now the fear is the Fed's going to bash it, so the markets are taking a hit again, realizing what a poor economy does to earnings.
Yeah.
And so we have this situation where the worse the economy does, the more probability we're going to get relief from the Fed.
Right.
This is absolutely perverse. And what I think is going to happen is, while everyone focuses on the U.S. economy, what the Fed is doing has international repercussions as well. You mentioned the rising dollar. You're going to get a crisis in the exchange markets. You're going to get a financial crisis in both in Europe and Japan. And I think ultimately what you're going to see happen in the months ahead, Jackie, is that the Europeans, the Japanese, the Chinese, the Brits, and us are going to get together, the U.S. going to get together and stabilize exchange rates. This will enable the Fed, in a face-saving way, of getting off of its high horse of trying to hurt the economy by artificially raising the cost of money, which is hitting mortgages, going to hit credit cards, hitting small businesses.
Steve, let me ask you about the big banks, right? The housing crisis hit the banks for a totally different reason. It was the loans and the packaging of the subprime mortgages and selling those out that ended up becoming an issue, and the banks needed to be bailed out by the Fed. But having said that, there is some concern right now, and I'm hearing these rumblings, having conversations with people saying, with interest rates so low, banks may have over-leveraged themselves. And now with rates on the rise, they could find themselves in a tight spot. Is this something that concerns you?
I think certainly the American banks, and I think some of the European ones, have recapitalized after the disaster of 2008, 2009. They were grossly over-leveraged then. So I think their balance sheets are in much better shape today. And so there's a tendency to think, well, this is what happened before, it'll happen again. I think the crisis, the so-called black swans that are going to come out of nowhere and hurt the economy are going to come from what happens with the dollar exchange rate, with the countries. Many countries can't pay their debts because they took on a lot of debt when money seemingly was free. So you're going to have those debt crises. You're going to have exchange rate crises.
Right. And
so I think you're going to have meetings to finally stabilize the situation, because the whole global economy is going downward.
And you brought
up that's not good for anything, especially politically.
Yeah, no. And you brought up a great point with respect to rates going up, hitting earnings. When earnings see losses, when companies see losses and they want to make those numbers look a little bit better, they lay people off. And so the labor market's been pretty strong, but that could be the next shoe to drop as well, and people could struggle there. Steve Forbes, always great to see you, sir. Thank you.
Thank you, Jackie. Appreciate it.